Hi, this is James Zhang, and today we're going to be talking about multifamily financing. Let's just jump right into it. So, my background, I was actually born and raised in Houston, went to school in Austin at UT, and I've been in DFW since 2006. I really started my career at GE Capital. I was in their commercial sort of finance management program on their GE Capital side, and then I really spent some time 8 years as a commercial underwriter. So I looked at office, industrial, retail, industrial, self storage, all the four sort of major food types they like to call it in commercial real estate. And then the last 6 years, I've been at Old Capital, really focused on multifamily. So I've done close to 900 million in loans. This year, hopefully, we'll get over a billion in multifamily loans across 135 properties, totally 14,000 units. So, seen a lot of multifamily properties, and then I've invested in close to 6,000 units across 18 properties in DFW, Austin, and San Antonio. I've probably done close to 30, and about 10 of those have sold in the last 2 or 3 years. So it's been a pretty good run on the investor side as well. All right, so I thought I'd start with this, and I think the number one thing that everyone has said is sort of on the COVID side is COVID has really just accelerated things that people already wanted, right? So whether it's work from home, whether it's the retail side, I think some of the things to highlight here that I saw, this came out of PwC's report on real estate, is affordable housing. Number one is probably on here. And then things that have stopped or slowed is really this appeal of CBDs and density. So we're going to talk about some of that. I think this is also unique, this apartment amenity wars. I think the amenities have just changed, right? Because the pool's not open, the gym's not open at a lot of these apartments. And so the amenities have changed into more sort of co-working spaces and things like that that people are using. So here's sort of high level what the market is seeing on the multifamily side. Jobs are still 10 million off of the peak, but the stimulus is coming out strong, right? So right now, I think it was 900 billion that they passed this year already, and then they're working on another $2 billion plan. And so it's not only going to help people immediately with the stimulus checks, but then also the unemployment backup on that. In terms of rent growth, I mean, I look at a lot of T12s. There has not been a lot of rent growth, even in sort of the Texas markets. To me, it's been pretty flat. In comparison to negative 10% or 15 or 20% in the more expensive markets, I think most investors will take flat. So in the affordable markets, Sunbelt markets, they're still seeing sort of at least a flat line, and we'll sort of compare A, B, and C a little bit later. This is number three is probably the biggest thing, is just that the amount of investor demand for multifamily continues to be super strong. It's coming from people who want to be in real assets, a better yield, but then also from office, from industrial, from retail, all those people are moving potentially more into multifamily. So it's coming from a lot of different places. But if you talk to operators, it is still, collections are difficult, right? And so you're having to not only get money from your tenants, but now you're having to apply for assistance from the Tarrant County or Dallas County and the cities within those to get some of the money because you can't evict people right now. So that's at a high level what I'm seeing, and I wanted to show you some charts. And everybody's sort of familiar that with the spike in unemployment, but then it's coming down, right, in terms of the unemployment. But I think this chart on the right sort of shows where unemployment has dramatically changed just based off of wages, right? So I mean, anybody making over 29 an hour, 18 to 29 an hour, it essentially, it's down a little bit, but it's 5% down, which isn't material, I would say. But this under 18, so that's all, think about like, your retail, hotel, any of sort of your service industry jobs, those have been hit very hard. And, those have sort of plateaued in terms of the change of employment. Like they just haven't come back, right? So until everyone gets vaccinated, this is going to be stuck here until it gets back up here, until everyone's vaccinated. So, uh, I think in terms of jobs, obviously you would want tenants in this top portion because they haven't been impacted nearly as much because they're probably all working from home. Um, this is a chart from the Fed's balance sheet, and you can go back to 2008, and it was up. I think this is a trillion. So once it's up a little bit, so it went from 1 to 2 back in 2008, 2009. Um, and then now this is up significantly from once COVID hit. So they have not held back on the balance sheet. And so I think this is what a lot of people are forecasting in terms of, all right, you add that much money to the system, it's going to inflate asset values. And so there might be some inflation just on normal things like your bread and your milk and your things at the grocery store. But what we've seen is this is sort of formulated into an asset bubble, and it's only a matter of time before the money gets to hard assets like multifamily. This one was around rent growth. And on the left-hand side, it really talks about how, once COVID hit, you could see the decline in lifestyle, under 2 to 3%. This is on a national basis. Overall was down a little bit, but then the renter by necessity, those people, the rents are still growing on a national basis. And then if you say, all right, well, where's it growing? What markets? This is sort of your migration patterns through U-Haul. You can see the red is your sort of standard coastal markets, expensive markets, and then your green is your in-migration markets. And so that's why a majority of my investments are here in Texas, but Dallas, Austin, San Antonio, Houston, all a ton of in-migration. In terms of sales, 2020 was off, right? In terms of total volume in sales. It sort of was back all the way to 2014 levels. I would say that a lot of this that we lost was in the coastal markets. We saw a lot of volume come back in Texas, sort of fourth quarter last year. And this, if you go to the right side, really this difference between your 10-year treasury, which was 50 60 basis points last year, it's come up to 1%, 1.10 right now. But if your cap rate's still 5% or 4.75, there's still a huge spread between those two. And then in comparison, apartment cap rates versus pretty much everything else that you could go out and buy at 5% is still a good yield. And if you're part of any of the Old Capital Facebook groups, I posted a snapshot from a 1099 that I had, and in February it was getting like, I don't know, 1,000 a month or something, and then it went to like $10 a month. It was just the amount that the Fed dropped the federal funds rate and then your corresponding savings rates. This money market, they had to, that's probably not even to scale. Like it's like they shouldn't even have a dot on there because it's so low right now on your money market funds sitting in cash. And so I thought this was Berkadia put this out around sort of a snapshot for Texas, because a lot of people will come in from, let's say, California or New York and say, all right, so what's the difference in the markets and how can I compare and contrast them? And so I thought this was a good snapshot between the two. The four markets. A lot of people, we'll start here. We'll start in Austin, right? So everybody's heard about Austin. There's so many people going to Austin. Look at the price per unit, right? So it's pretty much been flat year over year, 180,000 per unit in Austin. Cap rate about 4.3% on average. This is one of the things I want to highlight for people is that, like your median income is higher, right? So $80,000 in median income, but then the population is about 2.3 million. So Austin's relatively, I would say, small in comparison to Dallas, Fort Worth, and Houston. And so I think sometimes people think Austin's a huge market, and it's growing. There's no doubt it's growing, but it's about 2.3, which is about the same size as San Antonio. Right. So San Antonio, if you go down sort of I-35, go to San Antonio, average price per unit is about 90 a door. cap rate's about 5.7, and your population is about 2.6 there. But you can see your median household income is about 60,000 compared to Austin's about 80,000. So definitely San Antonio has a little bit more blue collar, not as many corporate headquarters obviously moving to San Antonio. So just your median household income is lower. That's translating to lower rents and thus lower price per unit. Go over to DFW. It's about 140, 150 a door right now. So it is pretty interesting that prices went up year over year, even through COVID. Cap rate about 5% and about 8 million in population. So one of the largest, if not the largest market in all of Texas. And if you go down to Houston, about the same size, 7.3 million. Median household income about 70, which is about the same as Dallas. And then the price per door, it's about 20,000 off, right? So if Dallas is 150 a door, Houston's about 130. And so we're seeing that across, A, B, and C, is that you can usually go down to Houston and buy a deal for 20,000 less a door. One of the things that might be off is insurance. So your insurance in Houston is typically more expensive. And so your NOI that you are capping is a little bit lower. So that's translating to the price per door being off a little bit. So I like this slide a lot. This is a combination of 4 slides from Berkadia. All right. So now let's jump into sort of what we're seeing across multifamily financing. And so I always like to start with this chart because it gives you a layout of what sort of your main options are. I mean, there's definitely always other options out there. But in terms of, starting on the left-hand side with a bank loan, this is what most people are going to start with when they're first getting started, because they can do a $500,000 bank loan. They can do, if the deal is not stabilized, if you don't have experience, bank loans where most people start. The problem is that it's recourse. It usually is shorter term, so 3 to 5 years, and then the amortization is 20 to 25 year. But the biggest benefit probably is your prepay. It's a step down prepay, so it's usually like a 3-2-1 as a percentage of the loan. As you get more experience, most people are moving into sort of your middle columns, Freddie Mac SBL, Freddie Mac conventional, Fannie Mae. These are all non-recourse. You need experience. It needs to be over $1 million. And the property needs to be stabilized. So 90% occupied for the last 90 days. And then rates right now, I would say low 3s for Freddie Mac conventional. So probably 3 to 325 on Freddie Mac conventional. Fannie Mae, Freddie Mac SBL are probably going to be in that 3.5 to 375 range, depending on the prepayment structure that you choose. And then non-recourse bridge, this is above 5 million. You can go out and get a non-recourse bridge. It's going to be 80% typically on your loan to value, and then it's interest only for the term. You need to be more experienced to do these non-recourse bridges. And then if it's over 5 million, you're probably going to be in that 4 to 5% range. But if it's under 5 million, there's just not as many lenders in that space. And so you're probably going to be 6, 7, 8% on like a $2 million non-recourse bridge if you don't want to go with a bank loan. So that was a lot. So hopefully you guys got, the overall feel. Now we're going to dive into sort of qualify for the loan next. So this is sort of how you qualify for these loans, right? So if I handed you a 100-unit deal for $10 million and I said, all right, in 60 days, you need to close it. Number one, they're going to look at your net worth of your sponsorship group. And then they're also going to look at your post-close liquidity and your prior multifamily experience. So on this sample deal, $10 million deal, let's say I give you 80% on your loan, $8 million in debt. So your sponsorship group needs $8 million in net worth in total. And then it needs 800,000 in post-close liquidity. So this is cash, marketable securities, anything non-retirement that your guarantors have. So they're going to add up everybody's bank statements, make sure you still have 800,000. And then if you want a non-recourse loan, they're going to want prior multifamily experience. So Fannie and Freddie are going to want prior multifamily experience, and then you're able to qualify for this $8 million loan. So a lot of times people don't have all these things by themselves, right? Especially if they're first getting started. So I like to break these guys up a little bit. I call them the deal guy, the multifamily experience guy, equity guy, balance sheet guy. And, if somebody goes out, finds the deal, they're raising equity, they might get 8% of the equity. Um, Multifamily experience guy, he has experience raising equity, 8%. And so as you go down the line, this guy's maybe just raising equity and then he's signing on the loan. He might get 2%. And then the balance sheet guy, um, the things that are, I would say, less valuable, or let's just say in less people have them. So if deals are hard to come by, if experience is hard to come by, those things are going to get more compensation, right? Versus if a lot of people can raise equity or a lot of people can sign on the loan, then those things are going to be valued less in terms of the equity compensation. And this adds up to 20%. So on some deals, it might be 15%, might be 10%. Of the equity will go to the sponsor as compensation for putting the deal together. So I get this question a lot is, all right, so what is a key principal? And so a key principal is somebody who is going to be signing on the loan. And so I wanted to highlight this is that you're going to sign on the loan. You might be have asset management control. You might have investment decision timing in terms of you making that decision, but you are not going to find a deal, close the deal. You aren't going to be involved really in the day-to-day. Typically that is going to just be the general partner. And so you still get all the benefit, but your job is really finding other general partners to invest in. And then you signing on the loan helps sort of build your resume. And then also you might potentially get some sponsorship equity here, like we talked about on the previous slide. All right, so now I'm going to go through, what I'm seeing sort of loan by loan and just hit these and give you some examples. Let me see. All right. So recourse bridge loan. So this is really priced off of federal funds rate, right? So fixed rate deal. So federal funds rate was, 2.5% back in 2019. Seems like ages ago, but right when COVID hit, Fed pretty much took it to zero. And so with that, banks price off of that. So you're right at probably 4 to 4.5 right now. And what we've seen is at the beginning of 2021 is banks are realizing that they got to lend some money out to make money and they can't just be on the sidelines forever. And one of the better places to be is multifamily. So we're actually seeing a lot more recourse bridge lenders out there right now in comparison to, I would say the summer of 2020. Most of them just shut their door because they had hotel loans out there. They had, all types of other commercial assets. They had loans against restaurants. They had all these things. And so they really didn't see a lot of light at the end of the tunnel. And not until really the beginning of this year have we seen a lot more recourse bank loans being quoted. So these work well for, under 5 million, not stabilized deals. And then potentially, if you have like a normal job outside of real estate, this works well because they like seeing a secondary source of income. So here's an example of a deal in Houston that we did. Essentially, Fannie and Freddie didn't want to do the deal because the borrower had limited experience or no experience. And so we did a recourse bank loan because the borrower had was essentially an accountant and an IT guy, had plenty of, secondary source of income, and that supported that deal. So we got a 5-year loan, 1-year IO, and 25-year AM thereafter. So that's an example of when you would use a recourse bank loan, and that was probably like a $2 or $3 million loan, so relative under 5 million, and that works really well on the recourse bank side. Freddie Mac SBL. So this is sort of like you're moving up one step. You're going to non-recourse, which is good. This is based off of 10-year treasury. So 10-year treasury dropped below, it was like 50, 60 basis points. Now it's back up to about 1.1%. But the all-in rate for Freddie Mac SBL right now is probably 3.5 to 4%, just depending on what market you're in, what your leverage is. So I would say the benefit for Freddie Mac SBL, number one is it's non-recourse. Second is it offers step down prepayment, and then also has you can get up to 3 years interest only. What we're seeing at the beginning of this year is that they want sponsors who are local. That they like that a lot. So they're going to look at, all right, where do you live? Where's the property? Can you get there in 30 minutes if you can't get on a plane? right? So if if flights shut down again, can you get to the property? So that's one. Second is how much experience do you have, right? So they want to see 2 years and 3 properties in terms of you signing on the loan and you having ownership experience in those deals. And so they're putting a little bit more focus on that. With Freddie Mac SBL, what you have to remember is every deal is going into Freddie for approval. And so it takes longer. So most deals on Freddie Mac SBL are probably taking anywhere from 60 to 75 days just to get approved right now. So once you get the third parties done, once you submit it for approval, it's taking about 60 to 75 days. And then we're seeing some lenders be a little bit more conservative on their underwriting because they are holding a portion of the risk. So if the loan does go bad, they lose money. The lenders do, which is good for everybody, right? Because it's making lenders be a little bit more conservative. But you just have to know which lenders to work with if you're looking for a little bit more aggressive terms. So this was a deal over in Fort Worth. It was probably in that $4 to $5 million range, and it was 90% occupied. But the owner hadn't raised rents in probably 3 or 4 years and hadn't done much in terms of rehab. And so the buyer decided, all right, I'm going to go in with a 7-year loan term, 2 years IO, and then do a step down prepay. And so they got a non-recourse Freddie Mac loan. They had done a couple of deals, probably they probably had 3 to 4 years of experience already on deals this size. And so they were able to qualify for Freddie SBL, and they were local to DFW. And so that allowed them to get this Freddie SBL loan pretty easily. Freddie Mac conventional. So this is if you move up to larger deals. So this is 7.5 million and up in loan amount. This is priced typically either over LIBOR or SOFR. So they're transitioning over the SOFR. And what we're seeing is this is the strongest thing, the best thing about this is the prepayment penalty, right? So after a 12-month lockout, it goes to 1%. And that is, a lot of people on Fannie Mae, they have yield maintenance, which is, that could be like 10% or 20% of the loan amount, depending on your loan term. So getting a 1% prepay is a big deal. It gives you a lot of flexibility. After 3 years, most indicators after 3 to 4 years, they're like, all right, I'm going to sell this deal. How do I get out? And the easiest way usually is if you have a 1% prepay. So that is probably the number one benefit. And that's because you're floating, your interest rate is floating the whole time. And so the bank doesn't have to go out and lock up this loan for a long time. They're going to essentially move your interest rate every month as it floats with LIBOR or SOFR. Some things to keep in mind is that Freddie is pretty strict on foreign guarantors for Freddie Mac conventional. And so you have to make sure that they want 5% post-close liquidity from that one guarantor. So we were doing a $20 million loan, and 10% would have been 2 million. So usually that's spread across the entire group. They wanted 5% from one person. So $1 million in post-close liquidity, which is pretty heavy for most people. Whereas Fannie would look at the entire group. So if you have a foreign guarantor, it might make more sense to go Fannie. Similar to SBL, every deal must go into Freddie for approval. So we're seeing, pre-screen typically the first week, and it takes about 2 weeks to get the final approval. And we're just seeing them be more conservative on their book overall. And so we're seeing lower leverage on Freddie Mac conventional. But if that 1% prepay is more important to you, then most people are just raising the additional equity. So here's a deal that closed at the end of 2020 in the fourth quarter. The acquisition, we were able to get floating plus 272 over, I think it was over LIBOR. Actually, they were transitioning over to SOFR. So it's probably 272 over SOFR. Essentially, they're on top of each other. They're like 8 basis points right now. So less than 3% all in, 75% LTV, 5 years IO, 10-year loan term. So that's the nice thing is that they're allowing you to have a longer loan term, but then it's only 1% prepay. So you don't have to worry about the maturity risk. Whereas typically on like a bridge loan, you only get 3 to 5 years, and then you have a 1% prepay. But then if you can't refi because COVID hit a month or two before your loan comes due, then you're in trouble. So I like the 10-year loan term, 5 years IO on Freddie. So a lot of people have been asking about reserve requirements, and the short answer is Freddie SBL has 12 months P&I, and then Freddie conventional has 9 months P&I. That's the short answer. But then if you take either a lower leverage deal, then this will come down, right? So if you take 65% and you get to 140, you might only have 6 months P&I. And then if you do assumption on any of these loans, you get no reserves on the assumption. And then people are asking, all right, so I do the loan in 2020, when do I get my money back? So usually it's the first, once all these declarations are lifted, they're going to test, essentially they're going to test to make sure you hit your collection number over the T3. And then they're going to want occupancy of at least 80%. All right, so that's Freddie. Let's go over to, here's a little bit more on Freddie. So every month, Freddie puts out sort of what deals have taken forbearance. So forbearance is essentially telling your lender, hey, I don't want to make payments for, let's say 3 months, and I'll catch up the payments, 12 months from now. And so right now there's close to 1,200 loans in forbearance, which is about 5% of the total loans. But the majority of the loans actually are just small balance loans. So we talked about small balance, we talked about conventional. 74% of the loans are small balance. And, a couple of reasons is that we talked about the hourly workers and the who have gotten hit more on the unemployment. And then think about it, if you have like an 8-unit deal and 2 of your units are out, then you're going to need help. Whereas if you do a larger deal, 200 units, if 5, 10, 15 people leave, you're still cash flowing. So they're seeing more hit on the small balance loans. And then 11% are student housing and 12% are senior. So I didn't touch on it at the very beginning, but COVID accelerated the trend of, I would say, more online learning and less dense senior housing. So that our COVID just hit senior housing a lot harder than most people expected for that space. And so, 20% of the loans are student or senior housing. So your conventional larger Freddie Mac loans aren't really having any issues. It's really the smaller loans. And then it's also the more specific student and senior housing on the Freddie Mac side. All right, let's go over to Fannie Mae. So Fannie Mae is very similar to Freddie Mac in terms of they want 90% occupied for 90 days. Leverage is similar. The big thing probably for them is that they have a DUS model, and the DUS model allows them to go a little bit quicker. Not every deal has to go to Fannie for approval. And then what we're seeing right now is a lot of people are going to more flexible prepayment options. So their fixed rate product is a little bit more competitive than Freddie right now. And so what we're seeing people do is do like a 10-year fix with a 7-year yield maintenance or a step down prepayment instead of doing the 9.5 years of yield maintenance. And so I think I'm going to show you. So this was a deal we closed in December last year, 248 units, 95% occupied. They were looking at a Freddie conventional, and they just ran out of time. They needed to close in 2020, and Freddie was just way backed up at the end of the last quarter and just couldn't get it done in time. So we went with Fannie, 75% LTV, 30-year AM, and then they did the 7-year yield maintenance instead of the 9.5, because most syndicators are going to exit sort of year 4, year 5. And so that's going to minimize their prepayment penalty. And it probably cost them about 15 basis points more on rate, but I think it's worth it. So here's an example. If you do a 10-year loan, 9.5-year yield maintenance, you're right at 330 right now. And then if you do a 10-7, you're about 345. So it costs you 15 basis points more. But that difference in yield maintenance can be like 5% of the loan. So it's a big number in terms of your prepayment penalty. All right, Fannie Mae has reserves as well. When they first came out, they wanted everything. So they wanted about 10% of the loan amount in reserve. So that was P&I, it was taxes, it was insurance, it was replacement reserve is how they calculated it. But then in July of 2020, they really cut it in half and went to just P&I. So you're seeing 12 months P&I if it's 6 million or above. And then on the smaller loans, it's 18 months P&I. And then they'll release it about 9 months later. if you hit the 125 cover that you were underwritten as. So a little bit higher than Freddie, as most 12 months P&I. But what we're seeing most people do is sort of, instead of raising all of their capex money, they'll raise 50% of their capex money and then use the remaining amount that comes back from the P&I reserve later, just so that they have that money ready to go probably in year 2, because a lot of people aren't doing huge rehabs right now anyways. So Fannie puts out their stats, and in terms of forbearances, we really saw it accelerate over the summer. So we got up to about 4 billion in loans that were requested forbearance, and then it sort of was flat through the fourth quarter, and then now we're seeing that number come down. So we're at 3.8 billion in terms of total forbearances, and it looks like a majority of them are pay in repayment. So what happened was, if you took forbearance and you got, let's say, 3 months of forbearance, then the next 12 months you had to make up those payments. And so all these guys are making up their payments right now. These guys are probably the ones that are in trouble. The 40 who extended the forbearance, they wanted more extension, or the forbearance expired and they're not paying it back yet. So there's probably 1 billion out there who are having trouble making their payment right now on the Fannie Mae side. All right, last one is going to be your non-recourse bridge. This is typically priced either over LIBOR or SOFR, most likely LIBOR right now. And, this is going to be higher leverage, right? So if you do over 5 million, you're probably in that 4 to 4.5% all-in rate. If you are under 5 million, you're probably 8 to 9% all in. But people doing this, they want a little bit more leverage. Let's say Fannie gives them 65%, and they want that additional 10%, then they can go out and get a non-recourse bridge on it. So here's a deal that we did here in Dallas, and it was 80% loan to cost, 3-year term, 3 years IO. It's floating rate with a 1% prepay. So the difference between Fannie and the bridge loan was probably about $2 million in their equity raise. So they had to raise that much less, and so they're going out executing their business plan. And then by year 2, the plan is to either refi to Fannie and Freddie or sell the asset at that point. This is the last couple slides I want to wrap up with is, when people reach out and they're like, all right, so, I'm buying this deal for $10 million and you're telling me I can only get a $6 million loan. Why is that? And usually the constraint right now is not the LTV. The constraint right now is this top line, which is minimum 125 debt service coverage. So debt service coverage is essentially your amortizing debt service times 1.25. That needs to be your net cash flow. And so when you look at this deal, just go to the bottom. The net cash flow is 1.7 million on this deal, and then your amortizing debt service is 1.4. That allows you to get a $28 million loan. And so let's say you said, all right, now instead of 35 million, I'm paying 36 million, 37 million. And you asked me, can I get a $29 million loan? The answer is no, because your net cash flow is still the same. Your debt service can't go up correspondingly. And so Fannie and Freddie are always going to size the loan that way. So I had a couple examples here, but I think I'm gonna take a pause there, get some water. And then if you guys have any questions, let me sort of stop there. If you guys have any questions, put it in the chat. We got some questions that came in from the registration, but if you guys have any questions, put it in the chat. And while I'm getting some water, we'll take those questions first. All right. So while we're waiting for questions, and I'll pull up the slide, I'll just go through some recent deals that we closed and sort of how we structured them. So Riata Ranch, that was in December. That was a Fannie Mae loan assumption. So you can assume the current loan and then put a supplemental on top of that. So that was out in Abilene. Wooded Creek was the Freddie Mac conventional. So they wanted the flexibility of that 1% prepay. And that one, we were actually up to 80% loan to value on that deal. Hazelwood was a cash out refinance. So we used Freddie Mac SBL. Essentia was similar to this one, loan assumption supplemental. Ridgemont's what we talked about, Freddie Mac SBL. Wedgwood Villas del Sol, that was a Fannie Mae loan. Um, and then Monterey, same thing, Fannie Mae loan. And then the Azul was the bridge loan that we talked about. So those are just some recent loan closings. Why people use us, really around, we can quote all of these loan options for you, right? And review the best ones or talk you through it, make sure you get all the way to the finish line, right? Because you have a lot of earnest money at risk. And so, we help you before the deal, during the deal, after the deal, and we charge the same as everybody else. So we charge 1% of the loan at close on all these transactions. So I'll check the chat to see if there's any questions. Okay. So I think Matthew had a question about the Fed increasing their balance sheet. So that one was really around, they came in and just started buying pretty much everything. They said they would buy corporate debt. They said they would buy, I don't know if they made investments in equities in terms of stocks, but they essentially would buy any sort of corporate bond out there. So they were buying bonds of airlines, they were buying bonds of casinos, and they were just shoring up, especially around the treasury market. So they would go out and buy all the treasuries and keep treasuries artificially low. And they didn't want interest rates to go higher for anybody. And so they just kept increasing their balance sheet. Larry asked around cap rates. Right now, what we've seen is cap rates have, it used to be 5, let's say for A property in Dallas, 5.5 for B, and then maybe 6 for C. And now it's essentially shifted like 100 basis points down. So A's are 4, B's are 4.5, and C's are 5. And so, it sort of goes back to that relative value of deals. And, in comparison to everything else, if interest rates continue to stay low, 10-year treasuries continues to stay low, savings accounts continue to pay nothing, then I think the competition for multifamily assets in areas that are in high demand in terms of population growth and job growth, those cap rates will continue to compress. The cap rates in coastal markets, expensive markets, urban markets, those are expanding right now. So, all right, let's hit the Q&A here. Larry asks, please comment on the use of hard money when presenting an LOI. Is it standard practice or just deal by deal? So hard money really presented itself in Dallas, I would say probably 2016, 2017. And what happened was the sellers looking for certainty of close. And if you're at $20 million and you can say, all right, I'm putting 200,000 day one or 400,000 day one, they'd rather have the 400,000. And so we haven't seen that many deals. I mean, I've maybe seen 1 or 2 where the person actually lost their hard money. Most of these deals are closing, but it just gives the seller certainty of execution. So if you are competing, I would say if you're competing on a listed deal in DFW, yes, you're going to have hard money. If you're competing on a deal out in a secondary, tertiary market or on the coast or a different market where you don't have, 20 bids and a best and final with 10 people, then you probably don't need the hard money. So I think it just depends on the demand from the buyers on that deal. All right, Omar asks, what are the options to get a loan for a non-US citizen? So you can get a loan, Fannie, Freddie, but the requirements are double. So you need 2 times the net worth of the loan amount and 2 times the liquidity, so 20% of the loan amount, and you can get a loan. But I would caution anybody sort of non-US citizen is that you will probably be lower leverage. So if they want 80% and a 125, you're probably going to be 75% and maybe like a 130 on a non-US citizen. So Fannie and Freddie are just government agencies or quasi-government agencies, so they make the rules. Tina asks, for smaller deals under 20 units, is it better to go with local banks or still finance with agency loans? So local banks are going to be a lot more flexible. They're going to be faster. They're going to be cheaper to work with, but they're recourse, right? So it's really, some people, they are fine signing recourse. No matter what, they're not going to let this deal go bad. So they're fine signing recourse. and local banks can close in like 30 days, and it's a lot more certainty of execution. Whereas agency loans take longer; they take 60 to 90 days, and then they might, you know, uh, not approve your deal, right? So if you don't structure your deal correctly, they might not approve it on the agency side. So for smaller deals, if it's under a million in loan amount, for sure you have to go recourse bank loan. But in that $1 to $2 million space, a lot of times we're still doing recourse bank loans just because they're easier to get done. You have more certainty of close, and you can close faster. Jerry asks, how do I improve my chances to get financing as a first-time buyer besides partnering with an experienced buyer? I'll say, I guess, one plug for a mortgage broker. I guess you could work with a mortgage broker that will help, because that'll give you associated credibility with that lender. Number two, I would say I would not try to leverage all the way up. So I would go to 80%. I go to probably 75% or 70% higher debt service coverage. And then I would also say you need a third-party property manager so that they're relying on the property manager. And then I would say buying in a primary market. So buy in Dallas, Austin, San Antonio, Houston versus a secondary or tertiary market, because there's going to be more lending options in your primary markets. So that's how it would improve. But the obvious thing is partnering with an experienced buyer would help significantly, because they're going to rely on that experienced buyer. All right. Bieta ask, where do I start? So I would say, depending on if you're a GP or LP, there's two different paths, right? So if you're an LP, your job is to focus on meeting general partners and getting opportunity exposure, what Jeremy Roll likes to say, and start seeing more deals, right? So if you're an LP, that's where I would start. If you're a GP, your job is to find deals. So I would start spending time figuring out what you can qualify for on a loan, and then start pursuing deals that sort of fit that box, right? So if you come talk to me and I say, look, you go buy a $5 million deal, then I would start finding listing brokers in a market that you want to buy in and start looking for $5 million deals and touring those. Travis asks, how can I see more deals? So same answer. If you're a general partner, I'd be focusing on listing brokers and getting on their list. If you're a limited partner, I'd be focused on finding general partners and seeing more transactions that way. You can definitely, if you're accredited, you can definitely go on, like Realty Mogul or Real Crowd or all these different crowdfunding websites and see more deals that way, just to get an idea sort of what's out there. Fred asks, how do I underwrite loan interest rates at the LOI stage? If it's a recourse bank loan, I'd probably be using like 4% right now, 4 to 4.5%. And then if it's a Freddie Fannie loan, I'd probably use 3.5 to 4%. So that's what I would start with right now. That's what the current rates are. Layla asks, do you see any changes in the lending environment in the next 6 to 12 months? Fannie and Freddie are pretty aggressive right now. I mean, they're doing a lot of lending on the multifamily side. I would say the biggest thing is the reserves. So people are still doing Fannie and Freddie loans even with the reserves. They're just adjusting their underwriting correspondingly and raising a little bit more money. But if everyone gets vaccinated, if collections sort of stabilize, if a lot of money goes into the system, Fannie and Freddie might take those reserves off. And that will probably be the biggest change in this year because I think at some point those will have to come off. So that's probably the biggest change in the next 6 to 12 months. Julie asks, is it best to invest in syndications as a passive or try to partner as a GP? At the beginning, you're probably going to start as a passive investor. When you're looking at partnering as a GP, you really need to add value to that group, right? So if you're either helping find a deal, you're helping with net worth and liquidity, you're helping raise equity, then you can be part of the GP and potentially get compensated for that. But most of the time you're going to be starting as a passive. So it really depends on what skill sets and what strengths you have before someone's going to let you partner as a GP. All right, Ryan asks, as a passive, should I go all in on one deal or spread across multiple? The advantage of a passive is you try to get some diversification. So as a passive, you might consider, all right, how do I spread across markets? How do I spread across general partners? Um, how do I spread across between, aggressive value add deals versus conservative yield plays? So as a passive, I would spread it across multiple, unless you are getting some sort of advantage, because um, usually there's a minimum on passive deals, but you typically don't get, like, if the minimum is 100,000 and you put in 250, it's not like you get any more return. You don't get any, sorry, you don't get a higher return for putting in 250. So if somebody comes in and says, well, if you put in 500,000, I'm going to give you a percentage extra, right? So that might be worth it. So just depending on what you're getting for the additional amount, but typically I'm not seeing a lot of deals where you're getting a lot more, unless you're putting, like, instead of putting 100, you put 500, which is a lot probably for most people. Do you have to have multifamily experience to get a loan? Yes, for Fannie, Freddie SBL, bridge loans, yes. But on the recourse bank side, no. So they're going to want you to sign, though, personally. All right, those are all the questions that I saw in the registration. In terms of next steps, subscribe to the channel, like the video, share the video. You need help with a term sheet on getting a loan quoted, or even reviewing a deal, send me T12, rent roll OM, or investment package. Happy to review it, give you my comments on it. And then, really just getting pre-qualified, send me a PFS, and we can set up time to talk about sort of buying, selling, refinancing your next deal. So I'm going to stop